Hello. All right. So if you were on the last video, we just finished up finance leases with guaranteed residual values. Now we're going to go into operating leases and how we deal with lease expense recognition. Both operating leases and finance leases for lessees are capitalized, but the expenses are a little different. Okay. So lease expense for the operating lease is going to be the same amount each method because we're going to use a straight line method. So we won't have the interest expense in a separate account, even though oddly enough we're going to capitalize it. So the lease expense is the interest expense on the lease liability plus the amortization of the right of use asset. And this is going to be weird, but you're like, well, we're calculating interest expense, then la-di-da. So, but if you look at this, so here's an amortization schedule for finance lease. Every time the interest expense plus the amortization will equal the payment. So here's the interest expense of $2,500 in this year 4. Here's the amortization, which is the change in the lease liability. Okay. You add them together, you get 14,404. Every time that's going to be true. So, one way to do it is, is to take the interest on the lease liability plus the amortization of the right of use asset. And another way to do it is the sum of the lease payments divided by the lease term. So let's see what happens. Whoa, that's not good. Randomly drew there. All right. Okay. So, yeah, that's okay. Interest on the lease liability, we know how to do that. It's the effective interest method. So this is the effective interest method. Effective interest method. This stuff can be really boring, so I'm kind of singing. AKA also known as just the interest method. Interest method. Beginning of period carrying value lease liability times the periodic effective interest rate. So we're doing annual, so that would be just the interest rate. If it's more than one payment per year, then it's the annual rate divided by the number of payments. Okay. And then the amortization is just going to be the difference, which I don't know. To me, it seems like a really goofy way to do it. Okay, so you're going to have this total lease expense, but you're going to put the interest part is going to reduce the lease liability. The amortization is going to reduce the right of use asset. So even though we have these different accounts, it's kind of like, instead of having it all go to lease liability, part of it's going to just go to the right of use asset. So we don't actually record interest expense. Okay. So the idea is that a finance lease is financing, so you should recognize the interest expense and amortize the liability. The operating lease is not a financing, so instead of recognizing interest expense, we just call it all lease expense. So it's really just a difference in classification. Under a finance expense, we'll amortize, the total expenses will be a little bit different because you'll amortize the right of use asset and you'll also amortize the lease liability, but the amortization of lease liability doesn't have an associated expense. It's just offset with cash. The interest expense is a separate expense. All right. And then where are you? Where are you, pen? I lost you. There you are. So every payment reduces lease liability. Every single payment reduces lease liability. Okay, so conceptually, that's what it is. I am going to start example 6 on another video, so we don't get it might go a little too long if I try to jam all that stuff, example 6, onto this one. So if you're feeling like example 6, I will see you on the flip side.